So in this video, we are going to be answering some questions that you guys gave us over on Facebook and Instagram. And I think that there's 12, maybe 13 questions. We'll probably timestamp it down below just so you can kind of jump around to the question that you want to hear answered. But these were some of the most common ones that we tend to hear. And so we just kind of picked them out of the bunch.
What's more important for getting approved by the banks? Your business credit score or personal credit score?
All right, great question to lead this thing off. Typically, banks are going to go off of your personal credit score first before they even take a look at your business credit profile. So here's how this works. Banks are always going to mitigate the risk by looking at what's had what they call the most long-standing data and also the longest history, right? And so obviously, the personal credit is going to be king because that's going to have the most history versus someone's business credit profile. Typically, you'll have a business, or typically the way that it works is we as people have personal credit before we have business credit. It's just the name of the game, right? So in most instances, if your personal credit score is lined up, you have a 720, 730 or more, right? You have those 5 accounts with at least $3,000 on average for each of those accounts, no late payments, no derogatories, no collections, no bankruptcies. Even if you maybe don't have a business credit score just yet, then again, 9 times out of 10, you'll most likely get approved for some form of business credit, especially if you have some pretty good financials to back it up in tandem with your personal credit profile. Now, if you're wondering, okay, Irv, well, where does business credit tie into all of this? Do I still actually need business credit? You just finished saying that I don't need a personal credit score. I want you to focus more on the business credit profile, not just a score. Because if you focus on your business credit profile, meaning you have your business properly classified on there across Equifax, Experian on the commercial side, Dun and Bradstreet, Safe Credit, then you're good to go, right? If you have your business profile where the address is the right address, whether it's a virtual address, a home address, or a brick and mortar location, and again, it's the same across the board, you're good to go. If you start getting trade lines reporting both vendor account and net 30 accounts on your credit profile, and it's actually reporting as trade lines, not trade references, then the score will naturally take care of itself. We've seen with all the bankers that we've worked with and all the clients that, again, we help scale their funding with, is they have strong credit, and then all of their business credit profile for whether it's one LLC, 2 LLCs, an S corp, like 3 businesses, whatever it is, that information is ultimately what the banks want to look at. That's really what they're looking at under the hood. The business credit score is just icing on the cake. And typically when the information is off on the business credit report, there's stuff that's not matching on there, that's when you start to see that credit score start to come down. So focus on the profile on the business side, and then everything else will take care of itself. What's the next question?
What's better for funding, an LLC, S corp, or C corp?
Um, it's not necessarily of which one's better for funding. So I want to rephrase that question that they asked. It's more so how you want your business to be structured for what you're looking to do, right? Whether you're looking to maybe save on taxes, or if maybe you're looking to take your company public, if it's a bigger company, or if you're looking to have some shareholders, figure that out first if that structure is aligned with what you're looking to do. Because I can tell you from, again, the clients that we've serviced, whether someone has an LLC, an S corp, or a C corp, as long as it's positioned properly, everything else is like lined up. The owner's credit profile, the addresses are on point. They have the right number of employees listed. They had the proper projected revenues, or they had the proper true revenues on there. It'll take care of itself. So we haven't seen a difference on amounts, whether it's a C corp, S corp, or LLC. But what I will say is this, and I know this wasn't on the question, but I want to add it, is there is a difference with sole props, because banks tend to look at sole props as like the individual. The difference is the LLC, the S corp, and the C corp. All of those are on the disregarded side, meaning that's a true separation. You have a corporate veil between your business and you. That doesn't happen on the sole prop side. And so the minute that you decide to maybe transition from maybe having the sole prop over to the LLC side, then you pretty much have to start the clock all over again. That would be the one caveat that I would say to the rule. But all thing else being equal, to go back to the opening question, regardless of the one that you're looking to pick, just know that you can get funding with it. It's just a matter of which one is going to be the best suited for your specific business model.
What credit score should I have if I want to get approved for $50K in business credit?
All right, so 50K, I would say that's baseline, definitely doable. I would say whether you are a brand new LLC, so I don't have much context on the situation. So whether you're a brand new LLC or an existing LLC, you should be able to get 50K, even if it's just to start out. Maybe some business credit cards, right? Your personal credit profile, though, off the bat, no late payments. I'm gonna give you like the obvious: no late payments, no bankruptcies, no repos. Some people say in the last 24 months. I don't want to see it. Period. Again, we're trying to set you up to win. We don't want to have like the bare minimum. Hey, what's the bare minimum that I need to know? We want to set you up to win. And so nothing negative on your file. The one thing that I can say is that if you do have a collection that you may be paid, or if you do have a charge off that you may be paid, and it doesn't come off, just make sure that on your credit report, it does show that it's settled for less, because that does have less of an impact, assuming you can't get that off of your credit completely. I always recommend that you try to wipe it off and clean it as best as you can. But if you can't, at least have it say that, because that does have less weight on the underwriting file, where it's settled for less, right? So it'll typically say the debt was 46,000, you may be settled for 30, as an example, right? In terms of accounts, let's talk about how many accounts you want to have. So if a underwriter is looking at your file, they're typically looking at a mix, but more importantly, they're looking at financial accounts that come issued from a bank. They're not going to be as impressed, or I'd say as swayed for a credit profile that has a ton of authorized users. So if you have your personal credit profile, and look, I've been there before. Like, dad hooked me up, helping me build out my personal credit profile back when I was building my stuff up. But you don't want to have more than two, right? From there, you just want to use that kind of like a springboard to get your own stuff. So max two authorized users. I've seen accounts where it looks like it's like a 700 something credit score, and they have 5 authorized users. Banks don't want to see that. They want to see primary accounts, which are accounts that are attached to your name, that you are the primary account holder on. That means that you physically applied for it. You physically had to run your own credit. You physically ran through the process, and you're not just piggybacking off of someone else. So no more than 2 authorized users. And then again, you want it to be bank issued cards. So that's Bank of America, that's Wells Fargo, that's Chase, that's Citi, a local credit union, Elon Financial. Those are bank issued. Don't worry so much about the tier just yet, but you want to start moving away if maybe you just have accounts that were issued by maybe Macy's or like store accounts. Those aren't necessarily going to serve you for the type of funding that you're looking for. So at least 5 accounts, revolving accounts. Again, that could be credit cards, that can be HELOCs, that can be a PLOC, personal line of credit, on the personal side, and an average of $3,000 or more. Remember, I'm just giving you baseline. $3,000 or more average for each of those accounts. The higher up that goes, the better. And then second to last is age, at least 4 years or older on an average collection of all the accounts. And then lastly, and this is probably the most important, payment history and payment utilization is going to make up 65% of your score. So you want to be diligent about making your payments on time. And if you're carrying a balance right now because you're not necessarily planning on going into a funding round, just know that when you do decide to go into a funding round, assuming you haven't been processing everything through business credit cards, I'm assuming you're maybe just starting out, you want to get your utilization down under 20%. The same time too, maybe 3 years ago, the way the climate was with banks, I probably would have said you could have gotten away with 35, 40%. That game is over. Less than 20%. I haven't seen enough of a reason to justify when people say, well, you want to keep some type of maybe balance on your accounts. I haven't seen a difference between someone having a 3% balance on an account and someone having a 0% balance on an account. I don't like carrying debt on the personal side unless I absolutely have to, right? We're maybe in a crunch for cash. I always like to use the stuff and then pay it off. Use the stuff and then pay it off. The lower rule of thumb is the lower that utilization is, the higher funding you're going to get.
What are the best banks for startups and new LLCs?
Best banks for startups and LLCs. I mean, I know that there's a lot of stuff like this on YouTube. I take a different spin on it. Is I always want to look at the biggest lever that we can pull on first. So, what's one move that if we did this move, we're going to get kind of like our biggest bang for our buck? Typically, the best bank for your LLC to get funding with is going to be whoever you had the longest partnership with. And so, if that's your local credit union, start there. If it's maybe your local bank, start there. If you've already been banking with Chase since you were like a student, like I had a Bank of America card since I was in college, I was like 19, debit card, and then we went into credit card and I started there, right? So you can start there, just because those accounts typically serve as a bridge in terms of like a partnership or relationship into the business side. And so banks, they want to keep you on their books. They want to keep you a happy customer. And so they actually want to see, hey, oh wow, you've been a personal client of ours now for 5 years. You opened up a business. Awesome, congratulations. Let's go over through the kind of like the Rolodex of products that we can offer you. And so they actually roll out the red carpet for you when you've been with them for some time. So I wouldn't worry too much about, which bank right now is giving the most or which bank right now, because that comes and goes. Banks are always giving out different specials. But the one true thing that you can always count on is to go to where you've already been getting service and where you're already working.
I have 3 different businesses that I need capital for. How should I structure my funding for each of them?
Okay, great question. So, three different businesses. How should you structure the funding for each of them? And so, here's like the mental model that I run through if I'm going to be structuring multiple businesses. And I always ask this to my clients first because some of them come in with a holding company and they come in with like 2 LLCs, or they come in with a holding company and then like 3 different corps, right? So here's how you want to structure it. You want to look at the one that you want to scale first, or the one that you want to scale the biggest. Because sometimes the one that you want funding for isn't necessarily the cash cow. And so I always ask first, and I want you to run yourself through this model, is which is the business that if I fund this one and I, juice it up 50K, 75, 150, like whatever that number is that you're looking to kind of like pour gasoline pretty much on the wood, is which one, if I inject capital into it, is going to give me my biggest return the quickest. And so I start working backwards from there. And usually whenever we ask that to clients, like everyone knows it. And I'm asking you that, pause the video, think about it. You probably already know the answer to that. That's where you want to start out. Now, sometimes you'll be in a position where you're thinking, okay, well, I have one business that maybe I already have a couple of credit lines for, but I'm really looking to scale a new business venture. You have to ask yourself, are you willing to leave a little bit more money on the table with a business model that's maybe already proven, you can flex financial muscles for, you can flex some cash flow with, to get this thing off the ground? If the answer is yes, then at that point, you would structure the funding for the business that you're looking to get off of the ground. And so the way that the structure is going to look is you're going to run through the funding sequence. Again, I always like to pick kind of like the rule of 2-2 or 3-2, where I'm picking 2 big banks, 2 regional banks, 2 small banks, or 3 big banks, 2 regional banks, 2 small banks, and or credit unions. And then I'm running that sequence, that framework on the business that I'm looking to get funding for. We always want to fund one business at a time before we move on to the next one. So once you get all the approvals for that business, you then want to analyze, okay, what was the total amount? And then from there, you can make the judgment call on maybe credit accounts or credit lines that should have been a little bit more higher, jump on the reconsideration line. Or, you know what, this is good enough. Let me go into a rest period. Let me make sure that we put this capital to use, and then rinse and repeat the process either over on the second entity, or rinse and repeat the process for that same business at a second go.
I keep getting denied for a basic business credit card, even though my business is 6 years old and I have a 720 credit score for all 3 bureaus. What can I do?
Um, if your business is 6 years old, and I'm assuming everything is operating correctly in terms of you're legitimately running a business, there has to be some information off about the way that the business is positioned and about the way that it's being perceived by the bank. Let me give you a real world scenario. We had a client similar profile, maybe a little bit higher, 740, and they kept getting denial after denial after denial. And so we started to look under the hood, and we're like, okay, Like, what the heck is going on here? You have a strong credit profile. You've been in business for some time. You got good financials. What's happening? Here's what ended up happening. There were two things, and I'm not necessarily saying that this is going to be the situation for you. This is why I'm giving you this kind of like this model to think through so that you can take a closer look. There were two things. Number one is there was a UCC filing placed on the business that they had no idea about, that a previous vendor that they had done business with still had that open judgment or that open lien against them. And so all they had to do was just call in, get that removed, wait for that to report. So typically 30-day cycles. Once that reported on the business credit profile, they were off to the races. The second thing that we had them do was take a look at the address. I can't tell you how many times an address just gets flagged by the bank, right? And so you can have an address, whether you got it from Opus, Regis, iPostal, all of them for the most part do the same thing. There's nothing really special about any of them. Just pick the one that's in your area, but just run a reverse search, guys, and see, okay, if I plug in this address, what comes up? Is there any bad press or bad media attached to the address, right? This business owner, unfortunately, had purchased or had gone through a registered agent. They were kind of like borrowing their address for the business side. And then when they went to go Google it, they noticed that there was a local presence in terms of media coverage on that address where there was a white collar crime that had been committed from that address. And so that was triggering over to the banks. And they were saying, oh, wait a minute, that's attached to this address. So maybe that business just changed names and now they're still operating that, even though it happened years ago, right? So that was just two things that they did. One more thing that I want to add is always pay attention to the industry code that you're using and make sure that the bank that you're going to or the banks that you're going to actually fund that line of work. Industry appetite and lending portfolios are a real thing in 2024 and beyond. And so if a bank doesn't want to lend to your industry, don't force it. You either have to A, reclassify the business, or B, move on to another financial institution. That's typically the options that you're going to have so that you can get the funding that you're looking to get. So I hope that answers your question.
Does changing the address or name of my company delete the age?
Great question. So a lot of people think that just because I change the name or I change the address, I lose the age. You don't lose the age, right? If you change the name, that's not necessarily changing the structure of the business as if you were maybe bringing on some partners or removing some partners. At that point, obviously, you would have to get yourself a new EIN. And then same thing with a new, I'd say, address or, name. Both are one-on-one the same in terms of it doesn't necessarily change the structure, right? It does work as a little bit as repositioning, which actually serves you in the long run if you do it right. But I'll give you a practical example to drive this point home. Let's say that I wanted to change my middle name. Am I still the same guy? Yes. Do I still like to eat the same stuff? Yes. Do I still like to go to the same places? Yes. Nothing changed about me or how I operate other than my name changed. Now, will I need to update that everywhere that's important? 100%, right? So think of if you just got married and you had to change your name, your date of birth did not change. So if you took someone else's name, maybe you switched from your maiden name to your spouse's name, your date of birth did not change. Same thing happens with address. How many of us are moving every year, right? We move all the time, every single year. A lot of us. I think the average American stays in the home, 3, maybe 4 years, the average family, and they're constantly moving, whether they're, upsizing, downsizing, whatever it is. Guess what? I was still born in 1990. I moved, bought a house. I was still born in 1990. I sold this house. I, decided to buy some multifamily. I decided to live out one of the units. I was still born in 1990. So I didn't lose my age and I still kept my social security number. That's the same thing that happens over on the business side. Even though you change the name of yourself or of the business, and even though you change the address, you still keep the age of when the business was established, which is what banks are going to look at, which typically they're able to pull right from Secretary of State for the state that the business was established. And now keep in mind, you still want to make the proper changes across the board. Whenever you make an address change or a name change, you want to notify your state, you want to notify the banks if you already have accounts, you want to notify the IRS. That still very much is so a real thing. But in terms of you losing the age, you're not going to lose the age. Like you're good to go.
What do you think is better, local banks or big banks like Chase, Wells Fargo, and Bank of America?
Great question. I think depending on what you're looking to do, they can all serve you. Like you're going to be able to do some things over at Chase that you may not necessarily be able to do over at a smaller bank and vice versa. So, for example, with Chase, at least right now, you might be able to get access to a Chase Business Inc. card in a nice bank account with them as a newer business versus maybe with a local bank. They may want to see a little bit more age on the LLC, sometimes 6 months, right, to a year before you can do things like that. But you want to have both inside of what I call like your weaponry of funding, where you want to be able to tap into both, right? They both serve their own purpose. You can do things at Chase, maybe get yourself a business credit card. Once your business is seasoned and maybe 6 months to a year, you can then go back with your taxes over with your local credit union or over with your bank, get yourself a business line of credit. Maybe it doesn't have any UCC filings. Like we know right now, regardless of dollar amount, you're going to get a UCC filing with bigger banks. That's just the name of the game. That's just what it is. And sometimes you can kind of bypass that with smaller banks because they want to earn your business. They want to bring in more clients, specifically on the business side, into their portfolio. And so use both to your advantage. It's not, this or that. It's this and that.
My personal credit is super low. Is it possible to get business credit just using my EIN?
Great question. So first things first is you want to ask yourself what type of business you're in. If you're just needing, let's say, gas cards, so for your travel, or you're just needing trade or vendor accounts. So let's say a trade or vendor account is like a net 30, a net 45. A good example of that is Home Depot. So you just needed to buy materials at that store, or you just needed to buy equipment at that store. Then you can very much so just get, again, vendor accounts or trade lines specifically for that, just using your EIN. Now, the other side of that is if you want financial accounts, also known as real cash value accounts, which is if I have a $50,000 business line of credit from the bank, I can use that for anything that I want, anywhere that I want, whether it's to cover payroll, buy real estate, buy materials, buy equipment, right? The difference here is that for financial accounts, you're going to need to have, or at least the owner is going to need to have a strong personal credit profile, 680 or higher minimum. If you're just going the trade account, then at that point, the business just needs to be organized, have its own EIN, and then you can start applying for those type of trade lines from the jump.
If I apply for a business credit card, how does the bank know when I'm ready for another?
Great question. So there's really two ways that you can handle this. Number one is you kind of want to pace it. So sometimes banks will know if you're ready for another account by them just flat out telling you, hey, here's a brand new offer. Would you like to take it? Or, hey, we've gone ahead and bumped up the amount of funding that you have or capital that you have in this account. That's like one of the ways that they do it. I always like to tell my clients, pace it. And so what I mean by pace it is you want to set on your calendar for all the banks that you bank with, every quarter, you want to have your financial review. And this is why this is why I've done so many videos on this, on knowing your numbers in your business and having a strong understanding of your financials, of where your business is. Here's the other thing, guys, before I finish this point, not just so much so that you can go ahead and get access to more capital. That's cool. But so that you actually become a legit business owner, right? So you can make real decisions with real numbers and real data for your business and for the people that work for you and with you, right? So I digress. Pulling back into this, you want to have a quarterly meeting set up with the bankers or with your bank, right? Walking in person and letting them know either, hey, this is what we did last month, or this is what we're projecting to do, and have the financials to back it up. If you're maybe not what I say number savvy, which hopefully you're not speaking that over your life, because that will keep you broke longer than you should be. You should at least have a baseline understanding of your numbers. Get with your CPA, get with your tax attorney, get with your tax strategist, and at least have them draft that thing out for you, your financials, and have them organize that portfolio for you. Your financials, your bank statements, cash flow, cash in, cash out, have all that ready to go. And as long as you're showing that it's trending up, so if you maybe last quarter you did $100,000, this quarter going into, let's say, quarter 3, you're now at 150. Well, guess what? That is a 50-point bump, or 50% bump rather, because you're going from 1 to 150. So you're actually trending upward, right? So your business looks healthy. Banks look at that and they say, okay, this is probably a good time since they've been using the capital that we've been giving them and they're on the up and up. Let's keep helping them inject more working capital into their business. Remember, They want to keep you a happy customer. So one of the ways that they're going to keep you a happy customer is by giving you more money that you can then pour back into your business and keep growing either the local economy or the national economy, depending on the line of work that you do. That's how I like to position our clients, and that's what I tell my clients. This is how you want to look at this versus just constantly waiting for them to say, okay, let me see if they give me a bump. Put it in front of them. Stay on their radar and come with the actual numbers so that, again, you're building a case on your behalf and they're going to want to do more business with you. I'll tell you what, guys, those are some freaking great questions. So we'll do this from time to time. Maybe put it on the map for every month or so. We'll post it online. So be on the lookout. Sometimes we'll post it on YouTube, mainly on Instagram and on Facebook. Just be on the lookout on my stories, where we're just asking for live Q&A that you guys ask your questions and we go ahead and pick the best ones and we answer them for you here. But other than that, I will see you guys in the next video. Bye.